Welcome to RPM, the podcast that explores the world of private markets. I'm your host, Michael Venn. Today we're talking about one of the oldest industries in the world, agriculture. And lately, ag has been front of mind for everyone. Let's dig into some of the details. Food prices have been rising along with inflation more generally. The FAO's food price index, for instance, recently hit an all-time high, exceeding the prior real dollar peak hit in the 1970s. Beyond the horrific humanitarian toll, the war in Ukraine has magnified commodity price inflation. Last year, two big climate conferences, COP26 and COP15, brought into sharper focus the importance of reducing carbon emissions and protecting Earth's biodiversity. Consumers are increasingly demanding greater sustainability of their food. The boom in venture capital-backed ideas and technologies has the potential to fundamentally change agricultural supply chains. And finally, the so-called democratization of private markets has created opportunities for non-institutional investors to invest in real assets. Joining me today to discuss these topics and more, Ryan Ramsey, a principal on our infrastructure and real assets team based in Sydney. Ryan, welcome to RPM.
Thanks, Michael. It's my pleasure to be talking to you today.
So Ryan, when people think of agriculture or ag, they tend to equate it with farming. But as we outlined in our research report, it's much more than that. Ryan, how do we define agriculture?
Yeah, thanks, Michael. It's, agriculture is not an asset class as such. It's really a sector. And it spans a range of different, asset classes, whether it be from sort of lower risk return farmland and infrastructure through to higher returning and risk, agribusiness and ag and food tech. If you think about it, it really sits at the intersection of, real estate, private equity, infra and venture. And I think why that's interesting is it allows investors to customize their strategy to gain exposure to the sector, but they can do that, with a range of different, return targets and risk profiles and other, portfolio characteristics like liquidity. The one thing that sort of links all of them is the role that each of those investment opportunity plays in facilitating, the agricultural supply chain to support the production of food, feed and fibre, which are all essential to sustain, the global population. And it's this essential service that really underpins the uncorrelated and resilient characteristics of the ag sector.
And I guess beyond those uncorrelated and resilient characteristics, what else is attracting investors?
Yeah, it's definitely part of the rationale. Especially when it comes to real assets, as I mentioned, there's different, investment opportunities within the ag sector, and they do have different characteristics as you'd expect. But real assets, which I guess has been our focus, has proven to be highly resilient through economic cycles. If you think about, correlation, which is a key sort of, reason why investors have been attracted to the sector in the past, most of the volatility does stem from weather-induced changes in supply, which impacts on inventory and then flows through to pricing. I think investors new to the sector often sort of misunderstand or are afraid of this risk, frankly, because it can be mitigated through strategy, whether it's, farmland leasing or different, business models that can help to manage this risk. But it's also this risk that causes agriculture to perform differently to most investments. And that's what helps to, reduce overall portfolio, volatility as a result. But at the end of the day, returns, they have to stack up on a risk-adjusted basis. They need to be competitive with other sectors. And I think as, the ag industry has matured over the last 10 to 15 years, there's a lot of good examples of how, ag has been able to achieve this.
So let's move to some more topical discussions, starting with inflation. Ag is often regarded as a hedge. Now that we are in the midst of our first inflationary cycle since the 1980s, how is ag holding up?
Yeah, very topical. Michael, we're at the Global Ag Conference, last week, and, ESG has been a big driving focus of sort of renewed interest in the ag and timber sectors more generally. But it was interesting just how big an issue inflation, is and how sort of much of a focus it is for investors right now. If you look at the correlation between ag returns and inflation, I think what's most interesting and I guess most important is how that hedge plays out in those highly inflationary periods where, inflation is unexpected. That's what, I guess we saw back in the 70s and 80s when we had our last big cycle. And through that cycle, ag performed, quite well with higher, cash returns and higher returns overall, which, helped investors to mitigate that, inflationary cycle. If we think about, what's happening now, the question is that same sort of correlation and a hedge playing out? And I think the simple answer is, yes, it is, quite clearly at this stage. Soft commodity prices are up, cash returns are, as a whole are up, and asset values are rising. Ag, like all industries, is facing some cost pressures around, supply chain constraints. But I think every industry is dealing with those issues, and at this stage, prices have more than offset those higher costs, and so higher profits are flowing through to the industry. If you think about the cause of that relationship, food is a key component of the CPI, but I think more importantly, spending on food is it's non-discretionary. We can't survive without it, and that's. Sounds like stating the absolute obvious. But if you look at, cycles, whether they be past economic cycles or even pandemics, obviously that's, pretty relevant, today. Because consumption's been very resilient through those cycles. What you do see is consumers changing where they eat. They might not go to out and eat, at a restaurant as many times a week. They'll eat more at home. But the actual volume of food that is consumed is pretty, constant through those cycles. And I guess that highlights that sort of really defensive, sort of resilient, characteristic.
Yeah, certainly felt that at the market this past weekend. So next is the Russian invasion of Ukraine, which has roiled commodity markets. Both countries are major exporters of wheat and corn. And to compound matters, Russia and Belarus are major exporters of fertilizer. Both factors have caused prices for food and other commodities to skyrocket, as you've just pointed out. And at the same time, forward prices for many of these commodities are heavily backwardated, which is, to say the market expects future prices to fall below the current spot price. There's a lot to unpack there. Ryan, what are you hearing about the effects of the war?
It's probably worthwhile sort of going back to the conditions that predated Ukraine. I think Ukraine's obviously brought it into a lot of focus, and I think food inflation has really bitten in the last month or two, where it's become, I guess, front and center both for investors but also consumers. But I think what's sort of lost in that is that food or underlying commodity prices had been building, for a couple of years prior to this time. And what we're seeing now, I think, is that really translating into food prices. Pre-Ukraine, grains and oilseed prices were already up. Coffee, sugar, cotton were all, a long way up on where they were, compared to the prior 10 years. So we're already sort of facing, quite a sort of high price environment pre-Ukraine. And that was due to a number of different demand and supply factors. We had a period globally of some less favourable weather conditions, which has the effect of reducing production volumes and inventory levels. There's the ever compounding effect of income growth in developing economies, which is resulting in the transition to higher quality diets. And what does that mean? It means more calories and more protein, and that has a bigger demand requirement on the industry. That compounds compared to sort of more basic diets, which are sort of carbohydrate rich. There has been a recent step up in demand for biofuels, in particular biodiesel in the USA, and that's a transitionary fuel as the industries develop technology and try and move towards electric vehicles, but plays a key role in that transition. And then lastly, you have just the COVID-induced logistics disruption that we're seeing across all supply chains. And that has had the effect of increasing the amount of inventory you actually need in the system. So all of that was playing out pre-Ukraine, and prices were up. I think then comes along the war in Ukraine, and that's, as you say, it's really relevant for grains and oilseeds markets. Between them, Russia, Ukraine are about 30% of global wheat and 15% of global corn exports. And that's a big part of the supply base to be sort of put into question. And as a result, we've seen prices increased very significantly for those two crops. As a result, they're up about 30%. The calendar year to date, off the back of already being up, quite a lot compared to the 10-year average. And then, as you say, there's also the issue around fertilizer. Russia and Belarus are 40% of the world's potash. That's, a big number. Russia, obviously a big supplier of nitrogen-based fertilizers, but also a big supplier of the natural gas that's used by other countries to produce fertilizer and to produce energy. And obviously that's a big topic of conversation, right now in Europe in particular, given the dependence there. So, I guess what does all of that mean? That supply, is at risk. Exports have effectively stopped out of Ukraine for the time being. And this is particularly relevant for the Middle East and North African countries, which are about 50% of the volume that normally comes out of, that part of the world. And these are countries that already have a high level of food security risk. I think on the fertilizer issue, it's probably more of a short-term problem. Those supply chains will, reroute, prices are up, it incentivizes new production to come online, but, that will all take a bit of time. So I think in the short term, the risk is around the large import markets, in particular Latin America and India. So that, I guess it does put a question mark over production yields in those countries or regions over the short term. And I think the importance of these two factors is, really just played out in commodity prices. There's a lot of risk, and as a result, prices have rallied, very significantly. These supply chains will eventually adjust and reroute, and as I said, new supply will come online. But it's going to take time, and there is a genuine risk that some portion of the production in Ukraine is lost for a period of time. So, sort of putting all that together, I guess, what does it mean? Well, as with all cycles, we expect that prices will moderate over time from their current sort of record levels. However, I think there's a few things that sort of underpin a more favourable outlook going forward. Those sort of demand and supply factors which preceded the Ukraine war all remain. So, they're not really going away. The trend away from globalization is really only getting stronger. Supply chains have changed from just in time to just in case. So the amount of inventory that the ag system needs to hold has increased. And all of this points towards sustained sort of upward pressure on prices over the long term. And so we think that the outlook certainly is looking a lot more favourable than it has for quite a long time. Certainly compared to the last 10 years.
Fascinating. So an important part of the ag story is the idea of greater efficiency, right? I mean, in our paper, we talked about over the last 50 years or so, the total output from farms has nearly tripled, while inputs have been virtually constant. A big part of this has been the utilization of fertilizer and pesticide. I would think there's only so much upside there, right? And to continue that trajectory, the efficiency gains are going to have to come elsewhere. Could you briefly talk about the role VC and ag tech are having in shaping the future of agriculture?
Yeah, so look, I think you're right in terms of the use of fertilizer in particular. The benefits of that have really been maxed out in most of the developed world. We've reached a point where you can't really apply it much more and get more benefit. In fact, many might argue that there's greater benefit from reducing fertilizer. So, that does mean we're increasingly dependent on, new technologies and ways of doing things. I think agriculture is often criticised as being slow in the uptake of technology, but I think this is, quite, well, at least a little unfair. If you look at total factor productivity, ag's exceeded the broad economy over the last 50, more years. And the row crop industry in particular has adopted a range of technologies, different seed traits and GPS-enabled equipment. There was tractors driving around, on GPS probably before any other industry other than perhaps, defence. And new no-till farming systems where, it's completely changed the way, row crop farming is undertaken. So the industry has always been, I think very adaptive to the tools that are available. and has to be adaptive, due to the fact they face, this, ever evolving weather risk, which with climate change is only getting, more variable. But they've been dealing with that and adapting to it, over a very long time. But I think what has happened in the past is that the technologies, or the investment and innovations has been fairly narrow. It's been, highly focused on inputs and equipment to support the row crop, sector. And what we're seeing with the rise in ag tech funding through that, venture community is a much broader base of sort of investment and interest, whether that be across different, subsectors, whether that be, at different points across the supply chain. And I think also a much greater focus on overcoming some of the sustainability, challenges that are faced by the sector.
So you mentioned climate change. I'd like to turn our attention to another element of the ag story, which is ESG. Last year, natural capital was a major focus of the UN's big climate conferences. How do we define natural capital, and how does it tie into investors' ESG ambitions?
Well, I guess I'd start by saying that, institutional investment into the ag sector has always been aligned with responsible investing principles. And what do I mean by that? Well, it's managing ESG risks and doing no harm. So, that's the base that, I guess the industry's worked from for quite a long period of time. Now, natural capital takes that one step further. It applies those same principles, but it involves sort of extending beyond that to try and capture ESG opportunities and actually do good, have a positive impact. So we define natural capital as those investments where there are clearly identified ESG opportunities to do good, to have a positive impact. And these objectives form a fundamental part of the investment case, just like with any, financial targets. And one of the attractions of the ag sector is there's actually quite strong alignment between sustainability and financial outcomes. Being more efficient with your inputs, improving the health of the soil. These are things that all, result in better yields, less variable yields, and ultimately better returns, for farmers. So that sort of alignment, I think really interesting and important part of the natural capital, opportunity. The ESG objectives that we focus on, it's about improving the environmental outcomes to help enhance, I guess the sustainability of production systems, especially in the light of, climate change, which is making, systems more variable and placing greater strain on conventional farming systems. So we think about those objectives being aligned with improving the sustainability of Earth's natural capital. And by that, we're talking about, air, land, water, and all of the connecting ecosystems which collectively, sustain life on this Earth.
This all sounds really good, but what does it mean, practically? What are some of the specific objectives that you're focused on?
Yeah, so we think about it with, I guess, on two levels. The first is decarbonisation. Ag and timber are, natural carbon sinks, and based on the technology that's available today, they're also the lowest cost carbon sinks to naturally sequester carbon. Put simply, that is, extracting carbon from the atmosphere and storing it in vegetation and soil. And so, we think this offers a, quite unique opportunity to generate carbon credits. But equally importantly, play a key role in supporting the transition to net zero. These carbon sinks can help to offset, the emissions that will continue in other sectors, which are, more difficult to mitigate for, a period of time, and ultimately can play a role in undoing some of the damage that has been done over time. A really interesting sort of opportunity for the ag and timber industries more generally is how that value creation opportunity starts to translate into, both revenue streams and asset values, because at this stage, it's still very early, and we think that's a real opportunity for investors. The other component is around biodiversity. I think one of the takeaways of the COP meetings is the importance of biodiversity to actually improve the resilience of, natural ecosystems to sustain climate change. And so this is, it's not all, I guess the key point is it's not all about carbon. We think biodiversity is, just as important in terms of, a sustainable, farming industry and broader, environmental ecosystems. So when it comes to biodiversity, this is, I guess, a much broader range of measures that we think about. It could be, how much of the activities involve regenerative farming techniques, which is all about, reducing the harmful, elements of some agricultural practices. It's improving, water quality that's coming off farms, or improving input efficiency and water efficiency. It's recycling waste streams, and it's, restoring marginal land to natural vegetation, where, often some land that's been used for farming for a long period of time, with the benefit of hindsight and today's, cost structures, perhaps shouldn't be farming it. And so can you take that back to, to nature? So that's just to name a few of the different, sort of more discrete, strategies or objectives that we're seeing. And, these are all opportunities that can be identified during DD, underwritten with, financial returns and managed and assessed against these objectives to, assess the impact that's being generated, just as we assess the financial returns that are being generated. And that's really the key thing with, that we think about from natural capital is, having strategic alignment with environmental impact, but also being able to assess and measure, the performance against those targets.
Really quite fascinating. Finally, I want to ask about ag's place in the so-called democratization of private markets. Agriculture has historically been the realm of large LPs, but that's changing as there are now several products that allow non-institutional investors to invest in real assets. Beyond diversification, what can ag contribute to an investor's portfolio?
I think I'd start by saying that, for non-institutions accessing the ag sector, in particular, farmland has been pretty difficult. Agribusiness is well represented in public markets. Most of the big global agribusiness operations are public. But getting access to farmland, has proven more difficult. There are some farmland, trusts that are listed in various markets, but I'd say as a whole, there's a bit of a mixed record, and often they've traded at a discount to NAV. What we're seeing with these new private market vehicles, it's allowing high net wealth or non-institutional investors to access the sector in a sort of structure that we think is more appropriate and better aligns with the long-term nature of farmland assets. They're not assets to trade weekly or monthly. They are long-term assets that form, I guess, have in a liquid nature, and that lends itself to holding them, over the long term. The historical interest, I think, has been around, the positive long-term industry fundamentals. I think that's something that sort of gained, I think, a lot of traction and is well understood. I think farmland as a store of value is also been important. And in the case of lease farmland, I guess that's an alternative to fixed income, especially in the low interest rate environment we've been in for quite a long time now. Buying lease farmland, which can generate a yield of 3-4% for row crops, maybe 6-8% for permanent crops, is a really attractive alternative when you combine the potential for long-term capital appreciation as well. So I think that's been the way most non-institutional investors have thought about it. But right now, I also think the inflationary risk and risk mitigation is a key driver where investors are trying to find ways to manage that. And as we've already spoken about, the ag as a whole and farmland in particular are really performing as we expected they would, and returns are for the time being offsetting that inflationary risk.
Ryan, it looks like we are out of time. Thank you so much again for joining me. I hear the weather has been rough in Oz. Please stay safe and hope to see you again soon.
Yeah, thanks, Michael. Look, appreciate your time today. We are really excited about the ag opportunity and natural capital, in particular. If you look at the big picture, there's still a fundamental societal challenge where over the next 20 years, we need to feed another, call it 1.5 billion people. And we need to do that while also improving the sustainability of the sector and its ability to withstand climate change. So, that's a big opportunity and also a big challenge. There's been a lot of talk about plant-based proteins or substitute proteins, and I think that will form a key part of the solution. But we really see that as complementary to the broader, ag, production systems, in particular, the protein production systems. At the end of the day, the industry can't keep up with demand at this stage. So we're going to need, to develop some of those new alternatives. But we also need to, increase the efficiency and utilize the finite resources we have. So, I think all of that, sets the industry up for, a really, really positive outlook. And so, look, I'll leave it at that. And look, thanks everyone for listening in today.
That does it for this episode of RPM. For more insights on investing in agriculture, including the white paper we referred to, please visit our website at stepstonegroup.com. You can also subscribe to RPM on Apple Podcasts, Stitcher, Spotify, and other podcast platforms.